Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this afternoon, we have McCormack, QQQ equity ETF strategist at Invesco, to discuss weekly trends in the Nasdaq-100. And Ryan, since we spoke last Wednesday, between August performance and kicking off September the way the Nasdaq-100 has, it's quite remarkable.
It really is, another week and another week of QQQ outperformance relative to the S&P. In this particular week, up 4.87% versus the S&P 500 at up 2.44. That's good for a 2.43 percentage points of outperformance. Beyond that, as we do from time to time, looking at the yearly performance or the year-to-date performance, it's even more staggering. QQQ up on the year over 41.4%. Relative to the S&P 500 at just under 10.6% for the year. So we've kind of crossed that 300 basis points of outperformance and are pushing 310. It truly is remarkable.
And let's take a look at the sector returns, because clearly technology, again, has been helping too with the performance of the index.
Yeah, the overweights, again, sometimes I feel like a broken record, but it's really the overweights that are pushing it, right? Information technology, communication services. And in this week, consumer discretionary was kind of the shining star, up 9.61% relative to its counterpart in the S&P, up 2.56. And we talk quite a bit about differentiation. In the case of consumer discretionary, you're seeing it real time, but the overweights to that sector, along with IT and communication services, continue to help drive that relative outperformance.
What about individual names?
Yeah, so I think it's interesting when you're looking at the chart that's there. We're looking at the largest contributors to QQQ performance for the past week, and the number is 16, but 4 of those holdings are not held in the S&P 500. To kind of dive more into that differentiation story, right? You have a quarter of the top 16 holdings are held in Qs and not in the S&P 500, not in a lot of other kind of well-known large cap indices. So that differentiation does help to explain this incredible performance. Looking at individual names, you have Tesla and Apple. Their stock splits went effective on August 31st. And as we look at from last week when we spoke on August 25th up through August 31st when the split was effective, Tesla shares up over 23%. Apple shares up nearly 3.4%. So this whole strategy of making it more accessible to the retail advisor certainly helped drive that stock performance. Beyond that, also on August 31st, another kind of differentiated holding would be Zoom Communications. Obviously, we've all become very familiar with Zoom in this post-COVID world. And they reported Q2 earnings after the close that really blew out expectations. You're looking at comparable EPS of roughly 64 cents. That was over a 40% beat relative to analyst expectations. Look at the sales numbers. Revenue of over 663 million bucks. That's nearly a 33% beat from analyst expectations, and that revenue represents a 355% year-over-year increase. So it's clear that Zoom has become a household name, but not only are they talking about the widespread growth that they're seeing in educators and school systems, small businesses over 10 employees, and then they highlighted some of their largest partnerships, including ExxonMobil and Activision Blizzard. So, this company has grown by gangbusters here over the past year, and its inclusion in the Nasdaq-100 is certainly welcome.
Ryan, I want to ask you a question about valuation on a higher level. We've seen many stocks, Tesla's a great example, that would add on valuations of large cap companies day after day. And there's the reasons for it. You can argue that the growth trends and a number of other trends have been accelerated, and you're seeing those returns what would have been over 3 to 5 years. In the course of a conversation, when you're talking to clients and other strategists, what do you think about valuation where we are right now?
Yeah, well, I think there are examples of times where the pockets of value outperform. I mean, you look at today as a perfect example, right? You see these really unloved names that are driving S&P performance ahead of this kind of non-farm payroll report due out on Friday for August, right? I think kind of this return to normalcy. And we've seen in weeks where the S&P 500 outperforms Qs, it's kind of along those same lines, right? That's where the story is. I think valuation relative to where we've been over the past 5 years, sure, it's elevated, right? But I think when you're looking at where we are today versus some other times in history, I think kind of tech bubble, we're not really at those levels, right? Even though we've seen unbelievable performance from these stocks and QQQ on the whole, when you're looking at performance, back 20 years ago, we're not even close to that irrational exuberance that we saw at that time frame. And not to mention, when we start looking at these businesses, these are very mature companies now. Yes, high growth, no doubt, right? We've talked ad nauseum about how they're innovative and their consistent commitment to R&D, but beyond that, they're not just hyper growth companies without sales or earnings, right? They've been able to monetize their business lines. I mean, you're seeing significant growth along the bottom line, and kind of traditional things like or traditional ways to return value to the shareholder, like dividends and buybacks. I mean, 20 years ago, that's not even on the table for a lot of these companies. So, I think, yes, valuations are elevated, and it's certainly something to be mindful of. But, these businesses are much different than they were 20 years ago. And like I said, I think, that commitment to R&D has really afforded them the flexibility to kind of move into these new growth arenas, right? Kind of make that investment in these transformative long-term trends. So, investors in general, I think, are paying up for, number one, the kind of quality balance sheets that we see a lot of these companies carrying. But beyond that, the investment and the potential earnings that these companies have kind of dived into when you look at some of these new and growing themes.
All right, Ryan, thanks so much for joining us on Trade Talks.
Thanks, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.